the truth about Tyson Foods Inc. TSN. All right, I like these guys. They're great. They serve food to a lot of people, and that's really important. The question, there's two things I want to talk about. The first thing is long-term value. Second thing is, with recent studies showing that because of the coronavirus and all this current stuff going on, like day-to-day restaurant sales growth is decreasing by like 35% versus a year ago. Like 35% of people, less people are going out, which like makes sense. You just think about it, like people don't want to be in public places. People don't want to go out to, this place. There's a ton of people. If they're afraid of getting a virus, then they're probably not going to want to surround themselves with tons of people they think could be infected. And so you've got a really, really fast plummet in like people going out to eat. Fast food restaurants like around the world are basically like closing their stores. So like you can't actually go inside, you just like can only go through the drive-through. And that's going to affect Tyson because Tyson serves a lot of the chicken for a lot of these big fast food companies. Like that's sort of their thing. It's fast food. And then also, really important to note here is like 16% of the revenue comes from Walmart. And Walmart is closing their stores because they don't want people to get the disease. Okay, so when you have a company where 16% of the money comes from a chain that is closing their stores so that people don't die, all of a sudden you get to have a little bit of a challenging situation, and it's kind of reflected with their stock. They've gone from, 75, 80 to 90 to $50, which is kind of crazy. The question is, like, is there value here? And also, what the heck is going on with the stock? So the first thing you're going to know is these guys are big, all right? They're no small duck. They're like 19 billion market cap. You look over at the financials, like, they deserve it. They've been growing for pretty consistently. The revenue is solid. They make like $40 billion a year. It's pretty amazing. They make a lot of money. They own a lot of brands. Some of the brands you might have heard of, some of them you might not have heard of. They got like Tyson Foods, Hillshire Farms, Jimmy Beer, like Fall Fry. They own all these food brands, and they serve a lot of food to a lot of people. If you look through the report, you're going to notice that they serve pork, chicken, prepped food, raw food, beef. I mean, they sell a lot of food to a lot of people. They do it internationally. They sell products to 145 countries. Everybody has to eat, and that's what Tyson does, is they sell people food. They're connected, hand in hand with those industrial farmers, and they get food at some of the best prices on the world because they buy at scale. And obviously there's competition, but I mean, it's really a simple business. They buy food and they process the food and then they sell the food. And that's basically all they do. It's not like that difficult to understand. If we look at how they've been performing pretty damn well up until recently, where their stock has kind of had like this free fall, which has been kind of harsh. And they're down right now to about the 100 monthly moving average, which is a level that's usually pretty difficult to get to. If we look historically at the stock during, entering recessionary times in like '08, once they hit that 100 monthly moving average, they were gone. I mean, they went below the 200 monthly moving average, and they tanked hardcore. They lost 23 to about, I think that looks like, $5. So they lost about 75% of their value. So, if we make that today, you'd be looking at about a $25 stock below the 200 monthly and losing about 75% of its value. Now, what's cool about these guys is they pay a really solid dividend over and over and over and over and over and over again through crashes even. The reason why is because they just make a lot of money. The payout ratio is about 27%, 28%, and it's still a pretty sizable, like 3% dividend. So, just looking at it from like a money perspective, these guys make a lot of money, and that's great. They have also, to go over to their balance sheet, they've got a pretty solid chunk of cash on hand, which is going to help them a lot if they have troubling times, because they've got 400, 500 million just sitting in the bank, and a ton of net receivables, which is awesome. The only thing I'm a little bit afraid of is they have a really, really high buildup of inventory. And I'm thinking like that could be a buildup of inventory because they're not selling enough. You guys saw the breakdown we did on TSM. It's the same kind of story with them. Like if you've got this excess inventory, it shows that maybe you aren't selling as much, or maybe your production isn't optimized. And to see them have $4 billion in inventory, it's scary, but I mean, similarly, this company's making $40 billion a year. So it's not like, completely unheard of that they might have that much in inventory. They've got some plants, 14 billion in plants, that's cool. Like, they make meat, so obviously they're gonna have debt to finance this stuff. They're paying, they got some debt on the balance sheet, and that's kind of cool. If we look over back at their income statement, we can look at their service on that debt. and it looks like their interest expense is about $500 million a year, which is pretty small. Like that's the same as their dividend, which is about 25% of the net profit. So give and take, you take their dividend, you take the what they're paying for their debt, you got about half of their net profits, and then everything else is kind of like gravy on top for these guys. If we look at their statistics, they've got some nice return on equity, return on assets. Like they invest and they make good money. Their profit margins are kind of what you would expect for a bulk food distributor. It's right around 7%, which isn't like outstanding, but it's still, it's better than Walmart, so it's pretty solid. And they do a pretty solid job, right? The short percent of float right now is about 2%. So not a lot of people think these guys are going to go down, even though the stock has lost literally half of its value in the past 2 months, 3 months. And so that's a little bit unsettling. That's kind of interesting. If we take a look at cash flow, it's not a difficult equation. These guys are leveraged. Obviously a lot of working capital is going away because of the big kind of recession and time periods we're in. But these guys, they make a lot of money. You got about $2 billion in net income every year, which I would expect to be a little bit higher for a $40 billion company, but it looks like they're trading about a 20x multiple of revenue, which I think is pretty reasonable. At least, cash flow revenue, not income statement revenue. Their income, like we said earlier, is about $40 billion a year, which is kind of crazy cool. But that translates obviously down to the bottom line. You've got a lot of stuff here. It's kind of just basic payments. They have a lot of debt, so they have to pay off that debt. What's good though is if we look at their book value, you're looking at a book value here of about $39 a share, so $40 a share. And that is a really solid book value. So they sold everything they had. They got rid of everything that they owned. They sold the pot, they sold their plants, and they just expunged all that stuff. They'd be worth about $40 a share, which is really solid. And that's kind of what makes me a little bit hesitant to put like a $24 or $25 target on this, because like their book value, like very rarely, are you going to have a company, unless for some reason it is super challenging and difficult, really big and like super big economic motivator. Unless that happens, very rarely are you going to have a stock that kind of goes below book value by a significant percentage. And so the question is this coronavirus news, is this global pandemic, is this international, bear market reason to say that these guys could go below book value by a significant percentage? And that's kind of what I want to break down when we look at these financials, is whether or not we really have something on the table here that can chop a lot, or whether it's just going to keep maintaining what it's been doing. They're, a very well-established company. They've been around for, 3 decades, 4 decades if you know how to do math, and 4 decades. These guys have been around forever, and so, they've weathered through a lot of recessions. And the question is this one going to be super volatile, or is it gonna not be super volatile? And I think the numbers are going to help us a lot with that. So if we look at insider trades, this is where stuff starts to get a little bit interesting. Before we actually get to the company, just looking at what people are doing in the past 6 months, there has been more people buying the stock than selling the stock, which is kind of interesting considering this happened. Isn't great. If you look at the insider trading in the past 3 months on the NASDAQ, we're going to see a pretty similar story. You got a pretty solid chunk of trades here, and a bulk of them are open market buys, and a minority of them are sells. So you got about a 6-to-1 buy to sell ratio. So a lot more people are buying the stock than selling it. So that's the first thing. It's a little bit unsettling to me, because you do have a lot of people buying the stock and not so many people selling the company. At least, quantity-wise. Share-wise, it's kind of even, and at least for the 3-month time frame, it's kind of even. And if you look longer term, even though there's more people buying the stock than selling the stock, there's actually more shares sold than shares bought. So I think that kind of helps our cause a little bit here, and it's something that we didn't really see on finance here, because we just saw the 6-month one. If we look at the past year, there have been more people selling than more people buying. And if we look specifically at the buys, most of these buys have been options executions. So these guys are getting paid basically with options. So it's not like an actual buy, but if you look at the actual sells, these are actual sells. These are automatic sells, which is a stop loss. These are sells, these are sells, these are sells, these are sells, these are sells. These are people that are actually dumping the stock and have obviously done a good job with it, because they were selling at 90 which I don't know if you guys noticed, but the stock has a 52-week high of 94. So these guys had some damn good timing to get out of here. And so I think we have a lot more people selling at these highs than people that are selling it, that are buying. These people are buying, their options are having a price basis of 0. And so you can kind of tell that they're getting some discounted stock here in payment for their services. So if we actually dig a little bit deeper, we realize that most people on the inside are selling this stock, and it's kind of reflected in the price. Now, the second thing I want to look at before we get into the numbers is an M setup. And the reason why is because this is a really, really, really solid setup. Now, there's a couple of things that kind of stand out here. The first thing is you got a MACD crossover. Now, the last time I had a MACD crossover, it went straight down. The time before that, it had a MACD crossover. It went straight down. The time before that, it had a MACD crossover that wasn't as well pronounced, and it kind of went down a little bit, and then it went up. The time before that, it was in like 2008, and it had a MACD crossover, and it went kind of like straight down. Then it had a MACD crossover right here, and for a little bit of time, it kind of went down. Then it had a MACD crossover here, and it went straight down. Then it had a MACD crossover over here, and it went down. It kind of went sideways and it went down. So basically what I'm saying is these MACD crossovers are really important, and they're only multiplied when you have a stochastic value that crosses through 50. So here the stochastics cross through 50, the MACD crosses, and you have a really big run up. Here you have the stochastic cross through 50, and it has this really big run down. Here the stochastics cross through 50, and it has a MACD crossover, and it has a really big run up. Here the stochastics cross through 50, and you have a MACD crossover, and it goes this really big run down. Here the stochastics cross through 50, and the MACD crosses, has this really big run up. And again, this is the weekly chart, or the monthly chart. This is the monthly chart. So this is the most stable indicators you can look at. And so these have proven to be really, really, really effective indicators. And that's why when I draw this M setup, I want you to keep these in mind. So what you're going to see here is pretty basic, okay? You've got it kind of near the bottom of the Bollinger Bands here, top of the Bollinger Bands here, bottom of the Bollinger Bands here, it bounces off the bottom of the Bollinger Bands, and then top of the Bollinger Bands here, it bounces off the top of the Bollinger Bands. And now, of course, it's gone straight down, and it's gone into the bottom of the Bollinger Band. And so here is your interior Bollinger Band M setup, which is really, really, really strong. And what's cool is as this is going on, you've got a MACD crossover, and you've got the stochastics going. Right now it's at 64. I want to see the stochastic red line hit 50. And as soon as it hits 50, I think that's when we're going to see validation of the interior Bollinger Band M setup. Now usually we have this setup, it's a pretty basic setup. You have the M, and you've got sort of your Bollinger Bands going around it, and it hits the bottom of the Bollinger Bands, and it hits the bottom of the Bollinger Bands, and it hits the bottom of the Bollinger Bands. Similarly, it hits the top of the Bollinger Bands here, and it bounces here. It's a really nice setup. So basically what I'm looking at as a profit target is you kind of take this price level right here from the first M, for the first part of the M, and this price level right here from the middle. Take that, and I want to basically just boop, boop, see if I can get this right. Kind of that length and then this length right here. So basically times 2 for whatever this is, right? That's sort of our aggressive target, and it's something that I think would kind of be like our golden scenario. Our less aggressive target would be just times 1 of those. So we'll see how that works out on the stock chart. So if we look at the height here from the first part of the M, we're looking at about, I don't know, 80 bucks. And the bottom here, I would say conservatively is about, 60 or so bucks. I'm just going to do some finger math. So we're going to take this height right here, we're going to subtract it, and that's going to get us right here to our 200 moving average. And then if we do it again, we're going to get to, about 10 bucks, which is kind of aggressive. I don't think it'll go that low, but I do think kind of within this range here is something that could really kind of be like right around here. I think it's a pretty nice target. And if we base it off of historically them losing 75% of their value in 2008, they lose 75% of their value from, give or take a $100 high. We're looking at about a $25 stock, maybe a $20 stock, which is kind of aggressive for an international food conglomerate. But just based off the charts, that's kind of what we're seeing here. And I think pretty reasonably, this should kind of go around to this 200 monthly moving average at around 30 bucks pretty easily. And 30 isn't too far of a stretch from 25, which isn't too far of a stretch from 20. And that's kind of what the play is here, is sort of assuming that they continue to close below this 100 monthly moving average. That's really going to be the validator for this setup. That's going to be what shows that this is a valid M and that we're going to have sort of our price going down here. Now, with that said, stop loss on this trade is pretty basic. I was going to stop loss kind of right around here. So kind of give or take 60 bucks. I wouldn't really want to see it retrace above 60. And again, I would want to see it confirmed by going below this 100 monthly on the monthly chart. And so there's a couple of ways you can look at that, and a couple of ways you can do that. Before we get into that though, I want to validate this in long term by looking at the financials and checking out the annual report. So the first thing we're going to see is obviously the stock is doing really, really well until it hasn't been doing really, really well. And then they crashed a bunch and then went below everything. But also the indices crashed, so you can't really blame them. The market's down like 30% a week. Basically what you see here is they make a lot of money, sell a lot of stuff. The more stuff they sell, the more money they make. They have a lot of debt, kind of sucks. I mean, they talk about here how they have to kind of, they have a lot of debt. I think what's cool is since rates just went to zero, they should be able to refinance a lot of their debt and save a lot of money on these corporate bond rates. Here we can see that they already have super low rates because this is a really well-established company. If we look up their WACC, it's about 7.5%, and I think pretty conservatively, assuming that the average cost of their debt right now is 7.5%. Considering how much rates just got cut, they should be able to refinance a bunch of that. They should be able to get that down to 6% if you ask me. Obviously, it's a volatile market, but with 0% rates available, I think they should be able to get that down. Here we can see that they have 19 million in cattle, 20 million in hogs. These are just commodity investments, very, very minor. You gotta remember, this is a $20 billion company. So for them to have a couple million and stuff like this in commodities, it really doesn't actually matter that much. They say right here that they have a bunch of debt at 2.5%. Basically, that's awesome because rates just went down a bunch. And so because it's fixed rate debt, they're basically they should be able to kind of refinance a bunch of that. They talk about here how a 10% decrease would increase the fair value of their debt, and thereby the fair value of their debt would go up. So they should be able to get better rates since all the rates have gone down a bunch. So that's kind of great for them. Their cost of sales, their sales, all this stuff looks great. 42 billion in sales, 37 in cost. Obviously, it costs money to serve chicken to somebody. It costs money to serve meat to somebody. They're a hard cost behind what they do, and that's totally cool. Great to see though that even though they're having a tough time, if we go over to the current balance sheet, the shareholders' equity still remains intact, which is good because I'm okay with this company struggling and losing 75% of its value, but I do want to make sure that they still have a positive shareholders' equity. And we can see right here, if we look at shareholders' equity, we've got give or take 13 billion in retained earnings. The equity is about $14 billion. So that's super, super nice. And it also validates that even if this temporarily does go below the book value of $40 to say $25, you've still got a lot of equity here that is going to maintain its value over time, hopefully, which is really good. Now, everything else we're looking at here is kind of basic. You're basically focusing on sort of the cash flow, the taxes, and there's not really that much else here. You can see they own a lot of stuff. They have inventory in animals, which they can kill and sell. It's kind of a disgusting business, to be honest. I don't know if I can stomach that stuff, but basically they make a bunch of money, and that's the big takeaway. They have great brands, they have great trademarks, they have well-established, clients in the marketplace that see their brand, and they have good brand recognition. And so that's obviously a strong plus for them versus some kind of generic, Walmart brand or Harris Teeter brand meat. They do have Tyson. They have the Tyson brand, and that makes them worth some nice money. You see kind of here their compensation plans. Most of it is non-vested, which is kind of not the best. They do give a lot of stock-based compensation, but for a company that's worth so much, giving out, give or take 1.5 million shares on a stock that's worth $100, that's give or take $100 million aggressively, assuming that's at the peak. That's really not that much for $20 billion company. And so really, end of the day, they look like a well-run company. They're a well-managed company, and honestly, they're just an effective group. I remember this one company I used to work with. Well, my mentor knew them, and then they knew them, and they sold their company to Tyson for I think 800 million. And so my point with that is these guys have cash, they have money, and they make a boatload of money. And in the long term, this is a solid company. There's very few people that are in the high scale, deliverability global food service industry for fulfilling bulk food. And I mean, these guys do it really, really, really well on a grocery store scale and on a fast food scale, and they have a lot of streams of income. You know, having your biggest client is Walmart might be a risk in terms of diversification, but I mean, your biggest client is Walmart, you know, like that's pretty great considering growth rates in the overall economy. Like that should translate into growth in Tyson stock. Similarly, a decrease in the overall economy, you know, could in the short term translate to a little bit of hurt for these guys. And that's really where we get back to the story on M setup. And basically, I'm thinking, like, if these guys close the month above this moving average, I want to see the next month start out red. If they close this month below the moving average here, like below 50, I think that's really going to be where shit starts hitting the fan. Stop loss on this trade is basically $55. I wouldn't do anything. I would basically, if you're conservative, I would wait for the next monthly candle to open up and then get in with a stop loss at like 56, 55. If you're getting in right now, you might have to stop at like 57. So you're risking about 10% here on an equity play, and your upside, you know, these guys going to like 30 is like 20 on a $50 stock. You're looking at a net gain in terms of equity. You know, we'll call it 30 conservatively. You have a conservative price target of $30. About a 73% gain. So you got about a 7-to-1 reward ratio on an equity play here. Now, if we transfer over to the options, exact same game here, exact same setup. I'm thinking tight stop loss around 57 should be about a $5 move in the underlying stock. The trade time frame here, I think it's about a 4-month trade to be honest. But we'll kind of go aggressively look at like September, October puts here. Yeah, I guess October could be kind of our aggressive target. I think October's kind of far out, but I would rather be safe than not safe. Safe than sorry. You're looking at a difference between July and October of about, you know, $5 to $6. It's about a 20% premium, I would say. And you're gonna pay for that, and you're gonna feel that, but you're also gonna have more time on the trade. You can split it up between Julys and honestly, like if they drop fast, you could do like some Aprils at like 45 strike, and those are, you know, those are 90 cents to they're about $2 for 45 strike. They're about $2 for 50 strike, 45 strike, or $3, $5 for 50, $2 for 45. But I just don't think that'll give you too much time for this to work out. It would be kind of tough to make it work out by April. So I'm going to go with the October ones. It gives you kind of the most time with a target of like $30 aggressive. And I mean, that's pretty reasonable. I think this is a pretty solid height right here. $30, I mean, they should be able to hit that as long as this M setup validates and they start to have a sell-off. 50 strikes are about 60, so that's going to give you an inherent value of 20 conservatively. So you do like 20 over 6. Basically, you're looking at a 3x return on your investment, which is pretty nice. I think these 45s are going to be better though. So these are about like $5, I'd say. That's going to give you an inherent value similarly of about $15. So kind of same. These 40s are also going to give you about a 3x return if it hits 30. 35s are about $2. That's about, you know, 2.5x return. But it kind of gets interesting because there's not a lot of volume on these, so it's a little bit of a tougher thing to say. The real money to be made on this trade is if they go down to like 25. If these guys could go to 25, that's going to add $5 onto your value on these contracts. And I'm not factoring in like in time value here, which should be kind of pretty high considering how volatile the market is. But if you could kind of hit these guys up with, if these guys go to 25, that's going to give you an extra $5 of leeway on these contracts. Even if they go to 27, that's going to give you a lot of extra leeway on these contracts, and that's going to turn this trade into kind of more like a 40 strike trade would turn into an implicit value of 13, and that's going to give you kind of like 13 over, I would say like 3-2. I don't like using 13 because it's unlucky, so I'm going to say 14 since I'm aggressive. It's about 4x return, and that's kind of more into the range that I would kind of be happy with seeing on this trade. It's a pretty solid return. You're looking at about 400%, 500%, 4x return here, assuming that it can go just a little bit deeper by October, which I think is pretty reasonable considering how much they've dropped so far. It's kind of crazy. The biggest risk here is that, like, this company is a solid company, and, you know, fundamentally, they make a lot of money. Like, they serve a lot of people and they do a lot of things that are very, very valuable in the marketplace. And so because they serve so many people, the biggest risk here is simply a risk that makes them a good long-term investment. which is that they just do a really great job of serving a lot of people, and the company just stays valuable because they do a lot of valuable things in the market. And that's kind of the one thing that kind of scares me a little bit about this position is, like, Tyson, like, is a really good company, and I mean, people can die, but like, people still need to eat, right? And I mean, even if you're going to the store and you're buying a bunch of chicken to go home and cook, and you're not going out to eat, then going out to eat is, I mean, it's like a 30% decline in the restaurant rate. Like, they aren't really as much in the restaurant game as someone like U.S. Foods. Like, they're more so in, like, fast food and just wholesale grocery. Like, you go to the grocery store, you buy Jimmy Dean sausages. And grocery stores right now are getting rampaged by so many people trying to, like, stock up for a pandemic and buy tons of food in preparation for a massive pandemic. And so because of that, like, you know, think about, like, if a hurricane's coming to town, everybody's going to be at the grocery store cleaning out the shelves, buying all the bread, buying all the food, buying all the breakfast sausages, buying all the chicken. And I think that's sort of the situation that Tyson's in right now, where you've kind of got two things that can happen. The first thing that can happen is that the economy takes shit and they do really badly because everyone sells off and no one goes out to buy food and everyone's cheap and the overall market crashes, and because of that they crash alongside it. And the second option is everyone goes to the store and everyone buys tons of food, and like everyone is just buying a boatload of their products because they're good products and people need to eat, and then the stock goes up a bunch. And so you kind of have two different things that could kind of happen here, which makes it a little bit of a tougher trade to make, because, you know, whether the question is how much of their stock price is going to be impacted by the overall economy, and how much of it is going to be impacted by the sort of demand for their goods. And that's a question that is a little bit harder to answer, but it's one that you can look at their past to understand. So if we look at what they did in 08, I mean, they had a pretty freaking massive crash, down 75% in 08. And so I think that's going to be our best frame of reference and our best thing to look at here. You can think about, like, you know, yes, people were still buying food in 2008, but the stock still crashed really hard. And they didn't even have an interior Bollinger Band M set up in 08. So that's kind of one of the things that I think could be the deciding factor with these guys is, you know, they're really heavily influenced by what the market does. This is basically, I think, a market play. And when you have market plays, what's cool is, like, first of all, stuff can work out really well and you can have, like, super solid investments. But at the end of the day, like, the most important thing is to understand that, you know, if stuff starts crashing, the coronavirus, like, continues, and everyone's freaking out about Walmart closing and Nike closing, Adidas closing, or I guess Adidas doesn't count, but, you know, Under Armour closing, like, all these stores closing, Starbucks closing their floors, McDonald's closing their seating spaces, you know, fast food companies shutting their doors and just doing, like, drive-throughs. If people harp on that, and the public persona and perception is focused alongside that, I mean, I think pretty easily you're going to see this economy play really turn out to be the more powerful of the two forces here. I mean, as long as this interior Bollinger Band M setup validates, I think pretty conservatively, you're looking at about a $30 stock right here, and that could be worth a lot of money, about 78% on pure equity. And if you're looking at these contracts that expire, you know, around the bouts of October, I mean, that's about a 4x return on your investment, which is really good in the short term. In the long term, what we're looking at here is a phenomenal company. What we're looking at here is a company that's experiencing some trouble because the economy is experiencing some trouble, and that is very reasonable and understandable. This is a great underlying company. There's no doubt in my mind that these guys are going to recover like they have year after year after year after year in the past, continue to grow to newfound heights. With that said, right now, they're still really high. I mean, they, like, conservatively are going to go to 40. Like, they need to come down. The question of whether they do it now or later is really not that difficult. Like, this is a pretty solid reversal pattern. If you look at it in terms of the monthly, you've got a pretty solid, you know, M set up here. I think it's kind of a matter of time for these guys dropping a bunch, because they have dropped so much historically. Like, they've gone from 9 to, you know, 4 over and over again, and they do drop pretty hardcore during crashes. And I mean, you see it in 87, you see it in 98, you see it in 08. I mean, these guys are very accustomed to losing, you know, 50+% of their value during a crash. I think that's exactly what we're going to see happen kind of right now. Is this is kind of just part of the downfall. A little bit late to the game, but really, I think you're going to see these guys kind of plummet a lot in the short term. What it's going to do is it's going to create a great opportunity to short the stock, great opportunity to buy puts, and it's also going to create a really awesome buying opportunity in like a year and a half or so after they eventually find their like really, really big bottom. And then really all you want to look for after that is you just want to look for a crossover on the MACD. And as soon as these guys cross over on the MACD in some kind of substantial way, like they did in '08, or they did in, I guess, 2009, that's really where you're going to start to see this reversal, and that's going to be probably the propellant that takes the stock from 30 to like 150, 250 in the next bull run. And so really, really a nice long-term investment here. It's a little bit overpriced right now, but in the long term, you got a really nice company here, a really nice stock, and a lot of money to make both shorting it and going long later on when the market recovers. This is a really, really phenomenal opportunity, and I think that's kind of the big takeaway with Tyson Foods. In the short term, honestly, if these guys close below like 49, like I want to be snapping up some of these puts because this is a really nice risk-reward ratio. I might get shorter time frame ones just because, to be perfectly honest, I think most of the coronavirus stuff will kind of like peak like early May, late April. So I might pop out some of these like May ones because they are going to be way, way, way cheaper than October ones. The May ones, I mean, they're just so much cheaper. You're looking at like $4 puts at 50, and that's going to give you an inherent value of like, $20, which is about a 5x return. And that's kind of going to be, I think, your sweet spot. You can get 45s for like $2, I'd say. That's going to give you an inherent value of 15. So you do 15 over 2, quick math. It's going to give you about a 7.5x return. A little bit more of an aggressive trade, trading those Mays. I think, that could be worth it pretty well. If this thing keeps dropping like it's been dropping, you're looking at a month of massive declines to 42, 40 strike. I think 40 will give you 45 strikes, a value of $5. With a conservative $40 target, that's about a 3x return. With the 50s, you're looking, at $10 in the money, that's about a 5x return, or maybe a 4x return. And then obviously the 52 5s are going to have an value of about 12, and that's going to be about a 3x return. So really a lot of great opportunity here trading this stock. And I'm kind of excited. I'll probably slap in some puts on these guys, assuming everything goes well this month. So they hit like 48, 49. Just shorter term stuff from May, and obviously a smaller position because it's a shorter time frame and a little bit more risk taken on because of that. But really, I think that's kind of the biggest takeaway here with Tyson Foods, and a really solid play to make on it. Hey, this is John. I want to thank you so much for making it to the end of the video and hope you get a ton of value from the stock that we just broke down and hopefully learned a lot about them. Now, what's cool is if you have an investment that you think could look really, really nice, or maybe it's a potential investment that you're on the edge about, or maybe it's a stock that you're holding right now that you're just a little bit curious about, or maybe you want to get an outside perspective on it, what's cool is you really comment down below with the ticker of the stock. I'll actually put it in Queen for a potential new video coming out. Now, make sure you also subscribe so that when those new videos do come out or when these new stocks do come out, you'll be able to get, YouTube will know to send you the stuff, and if you click the bell, you'll actually directly get a notification so that you don't miss any of the new investments that we break down on this channel. Now, what's also cool is if you want to learn how to outperform 99% of investors and radically limit your downside, even if you can't pass a finance test for your life or have nothing to start with but a few spare bucks, I want you to open up a new tab right now or go to a new browser, wherever you are, and I want you to go to stockmarketsecretsexposed.com. And inside Stock Market Secrets Exposed, you get instant access to a course I used to sell for thousands, a very, very high-level seminar I gave. The students literally go through and in their first month make 5 figures, and I can't guarantee anything, but I know for a fact that this stuff works and it's gold. What I want to do is I want to give you this course I used to sell for tons. I want to give it to you completely for free so you can learn the top 35 secrets that you can use within the next week to really, really crush your portfolio, really double it and radically limit that downside. So if you want instant access to that, what you got to do right now is open up a new browser tab and go to stockmarketsecretsexposed.com, and I'll send it to you for free. Okay? Sound cool? Sound fair? Thank you again so much for watching, and I will see you either in another video on here or over in the masterclass. Thanks. Bye.